Market volatility continues, with the S&P 500 falling 1.6% on the day. While earlier in the day, many of the indexes in the United States were actually trading positive, they turned that around by the end of the day. In terms of sector, the loser for the day was the real estate sector, falling 4.3%. The utilities also dragged it down, falling 3.5%. The winner for the day, though, was surprisingly the energy industry, which was the only sector to increase a total of 42 basis points on the day. The Dow Jones also fell 1.84% on the day. The Nasdaq fared slightly better, falling only 95 basis points on the day. In Canada, stocks actually had a really good day, with the S&P TSX Composite up 2.41% currently. Overall, the main sector that drove this increase was surprisingly the energy sector, with the S&P TSX Energy Capped Index going up a total of 15%. In Europe, the FTSE had a good day, up 2%. In Asia, the Nikkei was down 88 basis points. Not much happened in oil today, with WTI up 1.7% and Brent crude down 18 basis points. Gold didn't have a very good day at all, falling almost 2.5%. In the US and Canada Treasury markets, we saw the US 3-month actually have a pretty big increase, about 7 basis points. It's currently at that 13 basis point mark, roughly in line with the 6-month and 12-month. It's kind of interesting to see that shift just in that time range, which might have to do with the liquidity issues in the market that have been prevalent there. In Canada, the only notable change is in the 10-year, which is now at 70 basis points, which fell about 5 basis points on the day. In the currency markets, the Canadian dollar was the winner of the day, followed by the Chinese yuan and the Japanese yen. The losers on the day were the Australian dollar, followed by the euro and the British pound. With economic indicators often coming out after the fact, it can be hard pressed to find reliable numbers to really show where the economy is headed. This article here shows you just how bad things are starting to get in Germany as the slowdown in the economy as well as the closing down of businesses are really affecting them. So they have basically a wage subsidy, a lot like Canada does, in trying to help with employers really paying out to their employees when they probably wouldn't be able to without it. They might have to close down. So in total, 470,000 companies have applied to this subsidy in Germany. They also expect that the economy this year there is actually going to shrink by 2.8% this year, making it a pretty bad year for Germany overall. Large companies are also having to make tough decisions with layoffs, as Air Canada has now announced that they are planning on temporarily laying off a total of 16,500 staff due to the fallout from COVID-19. A lot of flights have been canceled. There's not much flights going around as many people are confined to their homes and just staying indoors. In total, it's estimated that about 15,200 of the workers are unionized workers, as well as about 1,300 managers will be laid off from the airline. This is actually in addition to their previous layoff of over 5,000 people, making a total layoff of over 21,000 people. They aren't the only company in the industry to have layoffs, with Transat Inc. Having laid off at least 3,600 flight attendants. WestJet has also seen about 6,900 people depart from their company. Hopefully things start picking up soon and that the layoffs don't last um, that long, but they expect that this will continue through April and May, at least for Air Canada. The United States retail industry has also seen massive layoffs, with Neiman Marcus Group laying off most of their 14,000 workers, as pretty much all their stores are now closed. This comes off the bat of yesterday. Macy's actually announced that they're cutting most of their 130,000 employees, as well as their stores have been closed down, and they don't see any opening happening sooner, as expected that this will continue at least till the end of April, if not longer. Housing numbers for the United States were released today for January. While that seems like a long time ago in the world we're living in today, it's still interesting to look at as their market did see a strong growth in January as they had a 3.9% annual gain, as well as in the 20 city composite, 3.1% year over year growth, although that is slightly lower than expectations of 3.23%. Phoenix continues to perform strongly for the eighth consecutive month as it posted a 6.9% annual gain. They've got a pretty hot housing market there, but it's hard to say how well that will continue as they might see more of a sharper drop than other cities in the near term. The interesting part about this is they're suggesting that they will see a 10% drop in home sales in spring resulting from the pandemic going on. In Canada, the RBC announced that they expect a 30% drop in housing sales to happen as well, and that they also expect prices to fall 2.9%. Overall, it seemed like a lot of economic data was remaining strong in January, as in Canada, GDP rose 0.1%, not significant, but overall you can see a lot of numbers from North America being relatively strong in January. But going forward, these next numbers we're going to see are really going to show quite how bad things are going to get. As Goldman Sachs Group has announced that they expect Q2 US GDP to fall 34% on an annualized basis, with unemployment rising to a level of 15%. On the upside, though, they expect that this is just a short-term hit, and they expect a strong rebound to happen in Q3. I expect things will probably be pretty bad in Q2, but I don't know how well things will cover in Q3, as we don't know how long this shutdown will happen for, as well as it's really hard to say how many businesses just aren't going to come back to life afterwards. The Federal Reserve continues to take action as they have now opened their seventh liquidity facility. So this new facility is called the Foreign and International Monetary Authorities, with an acronym of FEMA. And their plan of this is to try and help the liquidity markets. So foreign central banks can temporarily swap US government bonds with greenback in an attempt to increase liquidity in the treasuries market. As economies continue to deteriorate and many governments introducing stimulus packages and lowering interest rates, and the United States recently agreed upon a $2 trillion stimulus package to help offset the economy, the House Democrats in the US are actually looking to prepare for another round of economic stimulus. It isn't quite clear on how big this will be, but they say that the proposal will mainly focus on state aid as well as financial assistance for mortgage markets and the travel industry, as well as they want to get more direct payments into the pockets of everyday Americans. It's hard to say how much exactly this will be, especially when you have just released a $2 trillion package that will have to be funded somehow, especially when you consider how much money the central bank is also adding to that with the amount of bonds they're buying back, as well as issues they're having in the marketplace. They're going to be hard pressed to really extend that probably as much as they want to, because it comes down to will there be enough demand for the government securities? There always seems to be, but when you're gonna have out $2 trillion and then possibly maybe even try and do 2 trillion more, things might not go as well as planned. It might actually hurt in the long run. With everything that's going on in the world, I thought this article was pretty interesting as it takes a look into what companies may be looking to do in the future when it comes to China, as they expect China's global tech industry might not be as fruitful as it previously had, as tech companies might move over to different regions. It seems like a good idea for the region not to have most of their stuff there, as well as things that go on in China you really don't have much of control over, especially they could pretty much just take your patents, build your stuff without you, as they have done to certain tech companies. One company, Winston Corp, that assembles iPhones, has actually told analysts that they expect to have 50% of their capacity outside of China by 2021. Foxconn, that also works with Apple and manufacturing iPhones, has also been previously doing this where they've been making older iPhones in India. I think this is a good idea moving forward as there continues to be issues when it comes to the trade war as well as just privacy concerns and spying from the Chinese government. This also comes off the bat of today, Huawei actually warning that if the US takes more action against them specifically, that China will also continue to take action and increase tariff and things alike. There has been a lot of concern that Huawei is an extension of the Chinese government. They deny all this and say that actually roughly half their employees are really the owners of it, but it doesn't seem likely, especially when you hear stories of people just being taken out of their office and arrested by the Chinese military, never to be heard from again. They have did see some hits, Huawei did last year, but they still had significant growth with their sales rising 19.1% in 2019 and 19.5% in 2018. They also saw net income grow 5.6% last year, which though is down from the 25% growth in 2018. They have been seeing though uh, a reduction in demand from outside of China. Some of that probably has to do with increased in regulation and tariffs against China, and while they've been seeing a lot of their growth from inside China.